So today we have come up with session number 96, wherein we are going to discuss about the 2008 global financial crisis. So you would be thinking that now we are in 2023, then why are we discussing about an event which has happened in 2008? So friends, this is all about analyzing your past. So as we know, we as value investors study about the futuristic aspects of the company and also try to extrapolate things which is going to happen in the future by analyzing the past data. Similarly, here in 2008 financial crisis, this has been a big event meltdown in the global economy wherein various banks or various organizations has lost their credibility, huge loss in capital, etc. So it is very vital for us to understand what was the basis for this loss, what caused this big event, and what were the ripple effects of this event which has happened mainly in USA to all the other economies, and what was the long lasting effect of that in the other economies. And also we should understand what are the key takeaways from that global meltdown and what we as a investor should take care while investing in the current scenario from the learnings which we get from this global financial crisis. So I will be decoding this complete topic in a very simple language using some pictorial representation so that it is simpler for you to understand the complete sequence of events which has happened at that 2008 global financial crisis. So let's directly get into the topic. So if you see in 1996, soon after the dot-com boom, the tech companies had gone into a very high valuations. In 2000 to 2002, the bubble burst and stock market fell heavily. So in 2001, the bank interest rate, like the FD rates, fell to just 1% in US. So investors had no place to invest as the stocks were falling and the FD rates were also low. So what happened? The real estate was booming at this time. The US government promoted people to buy homes by reducing the interest rates and giving out cheap loans for the home loans basically. On the screen you can see some typical newspaper. In the Wall Street Journal, the news had come that the government had tried to bail out, but the plan got rejected and the market plunged, and many of the banks and investment banking and insurance companies went to complete scramble. Also, you must be thinking where we have seen this. So all these actors, they had done a movie, The Big Short. So in the Big Short movie, the entire global financial crisis of 2008 has been explained in a very structured way. And also all these things we will be absorbing in our coming slides in a very simple way, you can say. So if you see, a bank has got various accounts: current account, savings account, fixed or recurring deposits, and the various types of loans. These are the various instruments available with the bank. All these savings account, fixed FD, they will be taking the deposits from the various depositors, and they will be giving out some interest rate, and they will be giving out loans using this money to the required borrowers, and they will be taking higher interest rate than what they are giving out in these deposits, so that the delta, which we call as a spread in between this deposits and the loans, is the profit which is earned by the banks. So if you see what a bank does, the bank gives loan to the home buyers with good financials. So they will have a background check done in place. There are a lot of background checks organized by these banks so that they ensure that this whatever declarations or the assets which is declared by the home buyer is genuine and everything is in place so that they don't default on the home loan. Also, if you see, there is something called investment banker or simply investment bank. So investment banks acts as a mediator for helping companies to raise funds, and also they help in mergers and acquisitions, then also selling derivative products, and also they take part in doing derivative trading. So these are all what a investment banker will do, which we abbreviate as IB. So these are banks like Morgan Stanley, Goldman Sachs, etc. So what happened? These investment banks started buying loans from banks. Then they bundled it and formed complex derivative products called collateralized debt obligation, CDO. So that's what is represented on the screen. So again, to explain, banks were giving loans to the home buyers, and to reduce the or to transfer the risk of these home loans, they were giving these loans, and these loans were bought by the investment banks. So directly the risk of this was transferred to the investment bank. And what investment bank was doing, they were bundling it, all these loans, and formed complex derivative products named collateralized debt obligation, which is CDO. Now CDO is a complex structured financial product that is backed by pool of loans and other assets and sold to institutional investors. So you can see the CDOs were sold to institutional investors. So a CDO is a particular type of derivative, as its name tells. Its value is derived from another underlying asset. So now that you understand about a bank, a loan, a home buyer, an investment banker, CDO, collateralized debt obligation, and institutional investors. So now that you know all the participants till now, so now let's make it slightly more complicated. So as I told, till here we know. Now what they did, these investment banks contacted CRA, credit rating agencies, to get good ratings for the CDOs. So CRA evaluates the CDOs and rates it. So this is the credit rating agency. So after that, what happens? This investment banks sells the CDOs to the investors. So if the credit rating is good, then investors are very well interested in buying those CDOs which are very well credit rated, and it is bound to be uh, not to go to a default condition. So through the CDOs, the investment risk of the investors default by the home buyers were transferred to the investment banks by the banks, as I told. And then the investment bank transferred the risk to the investors by selling the CDO to them. And then the investment banks transfers the risk to the investors by selling the CDOs to them. So that's what is explained here. Like, the loan is bought by investment bank, and the risk of that loan is again transferred to the institutional investors by selling them the CDOs. So AAA ratings were given to such CDOs, and the investors jumped onto it for investing, as AAA rating is considered to be safe investments. As the demand increased for the CDO among the investors, investment banks demanded more loans from bank to create more CDO, because if they are selling CDO to investors, they are getting the commission and they are making money. So it's all about commission between various transactions. So investment banks asked or demanded more loans to be given, to be sold to them. So what banks did? So that's where we are going to have some issues. So what banks did? They tried to expand the home buyers by giving out home loans to those home buyers with bad financials. So earlier, as I told, they used to have background checks. They used to give home loan to people with good financials, because they will have the capability to repay the home loan, as they are having good financials, good salary job, and etc. Financial security. But here, uh, just for giving out the loans or selling out the loans to the investment banks, they started giving home loans to people with bad financials. No, bad financial means the bomb was ticking there, because if the borrowing done by the home loan or the home buyers, if they are unable to pay the loans back to the bank, then it will cause a default, and then the banks will have big issue recovering the amount. So such loans which were given to bad financial home buyers were called subprime mortgage at that time. So now again, these subprime mortgage were bought by investment banks. Then investment banks bundled those loans and made CDO, and the CDO were sold to the investors, institutional investors mainly, the big investors. And again, the credit rating agencies were given money by the investment bank illegally, and they were asked to rate this subprime mortgage based CDOs also as AAA rating. So as the credit rating agencies were getting paid well, so they were rating the CDOs without knowing the ticking bomb underneath. Now that I repeat the story, the subprime mortgage was given, then the investment banks made CDOs, then they sold it to investors. Credit rating agencies rated the CDOs, so investors were enthusiastically buying those CDOs. Then comes the role of insurance company here. So basically, you should know that, as I told earlier also, to sell more loans to investment banks and to get more commission, banks started giving loans to home buyers without much background verification of those home buyers. So investment banks like Countrywide Financial Corporation and Ameriquest Mortgage Company together had already sold approximately $177 billion subprime loans to investors. There were another grade of CDO, which is like CDO of CDO. Already CDO is a derivative, bundling of that derivatives, they had made a product, and there was CDOs made, which is again a bundle of CDOs. So it's like CDO of CDO, which was called synthetic CDO. So the total value of CDOs were almost 20 times the actual asset of home loans. Because derivatives, as you know, the underlying is the home loans, and the derivatives are again exponential values of those home loans. Actual value is something, but the CDOs which were built upon that were like 20 times the actual assets of the home loan. So that's how the big bubble was formed. And in 2000 to 2007, investment banks sold CDOs and earned in big billions. So the credit rating agencies also earned well. So those agencies were like Moody's, which is one of the largest, USA's largest credit rating agency at that time of 2000 to 2007. So in 2000 to 2007, the profits of credit rating agencies like Moody's went as high as 4x. So all continued well till the start of 2008, just like this. Now comes the role of insurance company. So if you see AIG, the world's largest insurance firm, started giving insurance on CDO. So AIG felt CDOs are AAA rated, again by the CRA companies. So it's safe bet, and then it started giving insurance on CDOs under the name Credit Default Swap, CDS. Here you can see on the screen. So what is the relevance of this insurance? So insurance is like, if the CDO fails, AIG, which is the insurance company, will pay the investors who hold the CDO. But the CDO holding investors has to keep paying the insurance premium. So it's like a normal insurance. The interesting fact here is that the CDS can be bought even by those who don't have CDO with them, which has a special scheme, unlike normal insurance schemes wherein the property or the asset has to be owned by them, for which they will get the insurance. So this credit default swap was also been bought by the investors. So another interesting fact here which is to be noted is that banks had given out the loans on adjustable interest rate, which is like floating interest rate for the subprime loans. So in later 3 to 4 years later, say in around 2007, the bank increased the interest rates, which majority of the subprime loan home buyers had no idea about. And because the dot-com bubble has just ended, so the US government was promoting the buying of homes, so the interest rate at that time was only just 1%, as I told in the early session of this video. And then as the interest rate was increased, and they started defaulting on the loan repayments because their income was very less for this subprime loans, wherein the uh, home buyers was having bad financials. So banks started selling homes and recover the loan amount. That's what, as you know, they do if the home buyer defaults on their loan repayment. Also, another mistake did by the bank is that, as an aggressive strategy, banks gave almost 100% loan amount with no down payment. So as you know, normally we pay around 20 to 25% of the home amount or the agreement amount as the down payment, and rest only is given out by the bank as home loan. But as a aggressive strategy to gain more uh, home buyers and to generate business and to gain commission from the investment banks to generate more home loans, banks were giving out almost 100% of the total agreement amount for the home buyers as home loan. So after selling too many home loans by the banks for subprime loan recovery, added by increased bank interest rate approximately 5% from earlier 1%, the demand for the homes went down and fell very low. The home buyers had bought the homes in early 2000 and at a very high rates when the demand was high, as I told, for the real estate. After the subprime loan default, as the home value prices dipped very low, the same went below the loan amount availed by the home buyers. For an example, if John Wick had bought the home in early 2000 at say $60,000, and after the defaulting issue and demand fell, the price fell to say $40,000, then the home buyers will think, why I am paying loan interest for $60,000 wherein the actual asset value is just $40,000. So all the borrowers started defaulting and the bank stopped getting money and stopped working. Because of this default, CDO value became zero, which are the derivatives of the home loans and which were actually going burst because everyone was defaulting. So the investors of CDO had to face full loss. Those investors or fund managers knew the reality of subprime loans. They knew CDOs will be failed anytime. So they had bought CDS in huge quantity. So CDS, again, as I told you, if the CDO is failing, then the insurance company has to pay the investors who had invested or bought this credit default swap, which is basically the insurance against the underlying CDO. So here the CDO when burst means the CDS holders will be paid by the AIG or insurance company and they will make good amount of money. And also I told that this CDS can be bought even by those investors who don't, or those investors who had not invested in CDO. So those investors who had not invested in CDO, which is broke now, and that they had bought only CDS for which the insurance will be paid by the insurance company. So they will be making billions and billions of money. So again, to repeat, those investors or fund managers who knew the reality of subprime loans, they knew CDOs would be failed anytime. So they had bought CDS in huge quantity. They made big profits when CDOs failed. So AIG had to incur at least a loss of as high as $99 billion. So to bail out AIG, US government had put in $85 billion to AIG to save jobs of AIG employees and to arrest the collapse. Because at that time AIG was the largest insurance company in US. Because of all this, people stopped buying CDOs. Then when lots of CDOs available with investment banks not to be bought by the investors, so the losses of the CDOs were to be borne by the investment bankers. So the top 5 investment bankers of US fell. Lehman Brothers, one of the top investment bankers of US, became bankrupt. Almost 2,500 jobs were lost. JP Morgan Chase bought Bear Stearns. Bank of America bought Merrill Lynch. Banks and other financial institutions lost approximately $450 billion, which is a huge loss. Remember that these figures, everything I am mentioning at the time of 2008. So if you consider the inflation rate, then the amounts, if you project it to the current date, it will be much, much higher. No regulatory rules were imposed on CDO at that time. The US Federal Reserve had the authority to regulate the mortgage loans, but they told no need to regulate the CDOs and CDS. This crisis led to credit crunch in the economy. Getting loans became so difficult, many companies starved due to inadequate funds. So again on the screen, I'm just depicting the CDS you can see, and also the synthetic CDO, which is CDO of CDO. And this were again bought by the investors, which again led to a big crisis. So that's like you can see the home loan went default and this led to a big crash. So companies had to be closed, unemployment increased, US economy crashed. US being the largest world's largest economy, it affected the global economy as well, and this led to US recession and global recession. Many countries became bankrupt in 2005 when Mr. Raghuram Rajan was the chief economist of IMF. In his research paper, he had indicated this crisis, but many investment banks had criticized him. And later, 3 years later, after 2005, in 2008, this crisis exactly happened. So if you see, as mentioned in this movie Big Shot, Dr. Michael Burry, he had made almost 100 million US dollar for self and almost 725 million dollar for his investors by buying this credit default swap CDS, which was like 1.6 billion dollar bet. And as CDOs failed, insurance companies paid them as he had CDS bought in them. So coming back to India in 2011, India allowed the introduction of CDS contracts in the Indian financial market. In 2012, SEBI allowed mutual funds to participate in CDS to hedge risk associated with the bond market. But RBI has put strict set of guidelines for the same. Unlike the big short CDS, in India, CDS of a reference entity can only be bought by a user who actually owns the reference entity. Unlike the one which was like in the case of AIG, wherein even if you don't own the CDO, you can buy CDS. Also, CDS cannot be traded in and out like other securities, unlike what has happened in 2008 in US, wherein the CDS can be traded like a security. When the dust settled from this huge collapse in US alone, almost $5 trillion in pension money, real estate value, 401k, savings and bonds had completely disappeared. 8 million people lost their jobs. 6 million people lost their homes. So this is just what has happened in US. So if you see, this is the extent of extra risk, whether it is a huge economy, a country, a huge institutional investor, or a huge bank, the so-called hard to fail or impossible to fail kind of institutions. So those organizations, whether it is insurance companies like AIG, or whether it is investment bankers like Lehman Brothers, or whether it is big banks, so they have failed. So if you over leverage, take excessive debts, and if those debts cannot be serviced, and you are taking, even if you think at your personal level, that if you are taking debts which cannot be paid back in a decent way, then debt will act as a two-sided sword, wherein it will kill your investments. Not only your investment, it will make you bankrupt. So it is very important, as we as investors, the learning to be taken here is that we should be very carefully selecting the debts, the exposure level of debts, the interest rates of those debts, whether it can be serviced by taking out that debt and investing in some investing instruments which will actually justify or exceed the interest rate of the debt and give you a extra delta which will help repay your debts also, and also create alpha. So as I always say, investment is so simple. Only thing which you have to understand is that your cost of capital should always be much lesser than your return on investment. So if you can create a spread or delta in between these two, the higher the delta in percentage wise terms, then the highest is your returns. Otherwise, if the interest rates are much higher than what you are earning by investing those loan amount, you will not be making a good investment there, and you will be making those investments as an asset to the lender, which probably is a bank. So it is very important for us to analyze these things, and financially, to become stronger and stable, you have to mitigate such risks of over leveraging and stay in your limits, so that you become a stable, patient, slow growing, long term investor. So hope this session was useful for you. If you have any comment, please feel free to comment in the comment box. In the future videos, in the next two videos, I will be analyzing or explaining how to analyze banking stocks, the parameters which are required for analyzing a banking stock, which is completely different from a normal stock. And in the session after that, in that I will be analyzing banks like HDFC Bank, South Indian Bank, Federal Bank, etc., wherein I will be comparing all the parameters which is to be taken care while analyzing a banking stock, and what are the factors which is to be considered while picking a good banking stock. So see you in next video. Till then, happy investing.